Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Once again, happy Friday, everybody. Hope things are going well for you, and happy June. We're just a little bit less than now 30 days from half the year being over. It's pretty amazing how quickly time flies. Hopefully you've had a good first half of the year almost. And you're stacking things up for a good summer buying season. Well, rates are stacking up to be pretty good right now for this summer buying season. We did see the jobs report number come in today. That has helped interest rates. I'll talk about the specific numbers of the job report here in a second, but the bottom line is rates finished the week better than where they ended last week, and we've actually broken through some pretty important technical levels, which are boding well for interest rates, at least right now, especially if they hold. So we might see a bit of a rally where interest rates continue to improve. From a technical perspective, what has happened is we've actually broken above, in terms of the price, above the 200-day moving average. A better price means yields come down and interest rates improve. And that's the first time that's happened since after the election. Once the election happened, boom, we broke below that 200-day moving average. And usually these, if we're able to sustain stuff, usually when we go above or below it, it's for a period of time. It's been 7 months now since we've been above the 200-day moving average. So if we can hold this here, we might see a bit of an improvement in terms of interest rates, and we'll keep you informed as to what happens there. Now, in terms of economic data, we did see personal income and spending. That showed an increase of 0.4%. That was in line with expectations, so it's not a dramatic increase to personal income and spending, which would typically be inflationary. Speaking of inflation, we did see the PCE, personal consumptions expenditures, number come in. That's the Fed's favorite gauge of inflation, and that showed actually a 0.2% decrease on the year-over-year number. It went from 1.7 or 1.9 down to 1.7. The core number decreased 0.1% from 1.6 down to 1.5. So it shows that there's some easing of some inflationary pressure, which is actually good for interest rates. And this is the second month in a row where we've actually seen the trend for lower inflation to happen, which is not what the Federal Reserve really wants. So, but it's good for interest rates. We also did see the Case-Shiller Index come in, and that showed, from the national perspective, an increase of 5.8% in terms of appreciation, which is actually one of the largest numbers that we've seen in a number of years. Now, the 20-city index, that came in a little bit less. It showed 5.7 for the 20-city index. And Denver actually is showing some easing compared to the rest of the country. Actually, I guess it's what's more accurate is the rest of the country is beginning to catch up, at least on the month-over-month numbers. Denver was right in the middle of the pack with a 1.3 month-over-month number. I mean, annualize that, that's over 12%. So that's still, pretty strong. But there's other parts of the country that, again, it was just right in the middle of the pack. So there's other parts of the country that are continuing to show, gaining some ground. The year-over-year numbers, Denver actually dropped from 3 down to 4. So Seattle is still rocking it. Portland's doing pretty good, but Dallas eclipsed Denver. Denver's year-over-year number was 8.3. Dallas was 8.4. So again, still a real strong number, but some of the country is gaining ground on us. Well, again, the biggest number in terms of economic data for this week was the jobs report. It did come out, and it was a stinker. Expectations were for about 170 to about 185,000 jobs added to the economy. The real number came in at about 135. So that is showing that there's maybe some weakness in expectations of what the jobs numbers should have been. The unemployment rate actually went down to 4.3%, which is, crazy low unemployment number. But the reality is that happened because almost 500,000 people left the workforce. So that's not inflationary when people leave. But the fact that we're at such a low unemployment number, on appearance is good, but still the jobs number disappointed. That caused interest rates to rally. And so we're seeing, again, interest rates at wonderful, wonderful levels, and we're back above that 200-day moving average, which is really important. So now the Fed's in a bit of a conundrum. They meet for the Federal Reserve meeting on July 13th and 14th, and expectations are for the Federal Reserve to once again increase credit. Everybody is still expecting that to happen, but showing that there's maybe with this weaker jobs numbers, lower inflationary pressures. We had a pretty low GDP number, so the Federal Reserve is not seeing what it would want to from an economic standpoint, because they want inflation and they want good economic indicators, and it's just not equating there. So we could see interest rates continue to get a little bit better or be around these levels, which is good. But we'll keep you informed as to what's going on. If you have any questions, please give us a call. If you're working this weekend, so are we. Thanks for joining me with Job with Jared, and we'll keep you informed. Bye-bye.